Hi, this video is going to show us how to make adjusting journal entries from a trial balance. So first, let's look and see what we're given. We have a trial balance, which is a listing of all of our accounts, and they're in the order assets, liabilities, owner's equity, revenue, and expenses. So you can remember that as a LOR. So let's find our assets first. Our assets are going to go from here to here. So cash is an asset because it's going to benefit us in the future. Accounts receivable is an asset because it's going to benefit us when we get the money that they owe us. Supplies is an asset because they're going to benefit us in the future. Inventory is an asset because it'll benefit us when we sell it. Prepaid insurance, that's always a funny one. That is an asset because we have insurance coverage that'll last us longer than a month or a period. So that coverage that we have from paying our insurance up front is our asset. Equipment is a long-term asset. And accumulated depreciation is what's known as a contra asset. That's why you see it with a credit balance, because it works the opposite of the asset. And then from there, we look at our liabilities. So unearned revenue is a liability because we owe them the work. So we haven't earned it, so we owe them the work. So that's a liability. Anything payable is a liability, so accounts payable and salaries payable. Our owner's equity accounts are capital and drawing right here. Then fees earned is our revenue, and then all of these are our expenses. So this was our unadjusted trial balance, and at the end of the period we look to it and we see, do we need to update any of those accounts for things that have happened that we haven't accounted for? And we do. We have A through E, and those are things that need to be updated. So letter A says accrued salary. What this means is that our employees have worked some hours, but we haven't paid them yet. So we need to debit salary expense to make our expense go up because they've done the work. And then we need to credit salary payable because accrual means that we haven't paid them yet. So instead of giving them cash, we're going to say we owe you. So that's salary payable. And they tell us that that's $6,000. So we'll just debit expense and credit liability. All right, let's talk about why we chose to debit the expense and to credit the liability. So expenses go up with a debit, and we needed to incur an expense, so we needed it to go up, so we debited it. And liabilities, like salary payable, go up with a credit, and we needed it to go up, so we credit it. And if you want an easy way to remember those rules, you can say, after eating dinner, let's read comics. So assets, expenses, and drawing go up with a debit. So that's why that expense went up with a debit. And liabilities, revenues, and capital go up with a credit. So that's why that liability went up with the credit. All right, for recorded depreciation on equipment, it's just going to be depreciation expense. And it goes up with a debit, so we're going to debit it for $1,000. And then accumulated depreciation, you can look over here and see that it has a normal credit balance. We need it to go up, so we're going to credit accumulated depreciation for equipment, $1,000. All right, and then for letter C, we earned $400 of previously unearned revenue. Well, the good news is whenever you see earned revenue, then you know that you need to credit fees earned because you need your revenue to go up. How did I know to credit it? Well, I knew I wanted it to go up, and it's over here. And remember, these go up with a debit and these go up with a credit. So if I want revenue to go up, I need to credit it. So I'm going to credit it for $400. So what do I debit? Well, I used to owe them, and now I owe them $400 less. When I owe work, that account is called unearned anything, but we called it unearned revenue. Could be unearned fees, but the word unearned is what tells you. And I need to reduce that liability. So like liability is right here as a credit, but because I have now earned some of it, I'm ready to reduce it. So to reduce a liability, I do the opposite of its normal balance, so I need to debit it. So I will debit that liability. All right, letter D. Billed customer $6,000 on account. So if you see the word billed, That means you've done the work and you need to tell your customers that they owe you. Once you've done the work, you're going to credit your revenue. So we'll credit fees earned. It was $6,000. All right, because once you bill them, that means you've done the work. So we're going to credit fees earned. But you're billing them because you haven't gotten the cash yet. So the account that we use when they owe us is accounts receivable. All right, so accounts receivable is an asset. Assets are over here with a debit balance. So to make it go up, because they now owe you more of a balance, so we'll debit that for $6,000. Letter E says recorded supplies used. So whenever you see the word used in accounting, that is how much you need to make your entry for. So once you've used up supplies, they become supplies expense. And they told us how much we used up. They said we used up $900. If they had given us an ending balance, we would have had to subtract it to see how much, but they told us how much was used up. So we're going to use $900 because that's how much was used. And then we're going to take it out of supplies because they're not available to us anymore because we've used them up. So supplies is an asset, has a normal debit balance, but we've used some up, so we need to make it go down. So in order to make an asset go down, we would credit it. So that is how to make these adjusting journal entries, and a little reminder about our normal balances and whether or not we're trying to make them go up or down. So let me know if you have any questions on that. Thanks.